Today, we're going to talk about 3 ways on how you can be able to identify liquidity in trading. First of all, you need to know what is liquidity. Liquidity simply means money. Money. Where money lies. Where money are. You understand? So, in trading, there are some areas where bulk or huge amount of money are. You understand? There are some areas whereby a significant amount of money rests in that particular areas. So now, as a trader, your job is to find out those areas and start making your entry from those areas so that you can be profitable, so that you can be milking from the market. Do you understand? Okay, so in today's video, I'm going to show you exactly the 3 ways. Now, first of all, there are 3 areas that are likely sure that a huge amount of money are always found in these 3 areas, in these 3 places. Now, firstly is our daily high and daily low candlestick. Now, if you can see, this is our daily time frame. Yeah, and in this daily time frame, this is our daily high, and this is our daily low. So liquidity, or let's say money, a huge amount of money reside above here and also below here. If you take it to, if you shift to the current market price, you will see that price is already taking out the liquidity residing in this daily candlestick low. Price is already sweeping the liquidity already. Now, this is also a draw in liquidity. I don't know if you understand. This is a draw in liquidity. Also refers as a place whereby, yes, there are also liquidity residing there. You can see liquidity, you understand? So, if price should take out this low of this daily candlestick, what are we expecting? If you are trading London Q zone, you're going to understand this particular pattern. After the low has been swept of the sell side liquidity, we'll be taking what? The buy side liquidity. So now the sell side is gone, we are targeting what? The buy side liquidity. Targeting here. But because we have a drop in liquidity here, these are all huge amounts of liquidity residing there. You understand? So price will surely take out this draw in liquidity after sweeping this buy side liquidity. So the second way we have is our double bottom or our double high. Now you can see this as a equal high. Yes, actually equal high or double bottom, equal high, and also our equal lows. This can serve as our equal high. From here to here is our equal high, and price is likely to surge up and sweep the whole liquidity residing above here. This is a liquidity area. You understand? Now, if you want to trade equal highs and equal lows, you can't just enter like this. You enter from here. You can't just enter from here and put your stop loss below here. You know what price will do to you? Price is going to tap you in, give you a little profit, and take you out, sweeping the whole liquidity here before giving a change of character to the downside and continue the down movement. That is why sometimes you are going to, your price is going to take your stop loss before going to your directions. And that stop loss price taking is not that, it's just liquidity. Price swept liquidity. The liquidity deciding above or below that particular place you set your stop loss. Price swept it and your stop loss is part of them. Understand? Because so many people, we are all seeing the same thing in the market. So if everybody is buying from, is selling from here, that stop loss will be at least above this particular area, and you will not expect price to be blind. If everybody put that stop loss here, yeah, you guys are all accumulating big amount of funds, and prices have to take all of you guys out and eat your stop loss before spreading it down. Do you understand? Okay, the second most high value place, or the third, yeah, the first one is equal highs. No, the first one is daily high and daily low. The second one is equal highs and equal lows. Now, the third most valued place whereby you can be able to catch liquidity is our support or our resistance area, our demand or our supply zone. Now, talking of support and resistance, we used to have something like this. That is our resistance, and this is our support level. If price should go up, this resistance is going to resist it from going up and send it back down. This support level is going to support it from not going down further and send it again back up. Now, all these are just creating liquidity. They are just creating liquidity. Where is the liquidity? The liquidity resides here. The liquidity resides here. You know why? Because people that trade breakout, or some people, first of all, they'll enter here. Put the stop loss here. They will catch this movement. It will be sweet for them. They will enter again. Yeah, there's some people that only trade range. The only focus is on range or range breakout. There's some people that they see that as a normal trading strategy. They'll catch this move again. They will do it again. They'll catch this move again. These are only what they are trading. Understand? And now their new expectation is if price will come back there again, like this, they should be able to catch this move. That's what they'll be expecting. But price will now shock them, tapping them in, give the little profit, and break out entirely from here. You understand? Price will break out entirely from here, sweeping the whole liquidity residing here. Do you know? And price will now return to something like this. Now, you know something about Forex. You think you know it all, but you don't know anything. Now, after seeing this, do you know what they will do again? They will mark here as a new, or they'll mark here, okay, look at it here first. They first of all mark here as a breakout. This is our breakout, guys. This is our breakout. And after seeing the breakout, they'll place the entry here and put that stop loss below here. You can see they have already eaten stop loss already. Price have already taken them out already. So they'll say, okay, let's refine everything, let's change everything. They'll not mark here out as their new support, that okay, price is going to go up, and they'll not mark it out as their new resistance, that if price can go up, we are selling from here. We are selling from here. We are selling from here. Stop loss there, like this. Like this. And the market will honor their invitation tag them in. Now they're only complaining that the price took them out before going to the direction. You give them that little profit again and do it again. Boom. This will keep happening, and before you know it, all their money that they have made from this 3 lucky trade, they will lose it to the market and they'll start complaining. More trading is a scam. Strategies are not working. I don't understand this method. In fact, what have I put myself into? And they will not do what? They will not go into the market or go into YouTube and start looking for more and more strategies to learn. By so doing, they will be able to confuse themselves. They'll confuse themselves about trading and they will lose it all. So let's talk about how to trade with liquidity. So first of all, the first example we'll be doing is in our daily high and daily low. That will be the first example we'll be doing. Now, we are going to be taking this daily high and daily low as example. This candlestick. Now, this is our candlestick and this is our daily high. And this is also our daily low in the candlestick. Yeah. So, after price have already swept the sell side liquidity, you all can see it. You are not blind. You can see it here. Price swept the sell side liquidity. What happened next? Price did what? Dished out to the buy side liquidity. If you're able to catch this move in the lower time frame, let's say now 15-minute time frame, yeah, this is the sweep here, just a little sweep. If you're able to catch this move, you will be in a bigger profit side. Your stop loss, once price already swept liquidity, don't be scared about stop loss because it will be very hard and rare for price to return. You understand? And your TP should be above here without drawing liquidity. Price took it out and smashed it easily. This is a 1:10 risk to reward ratio. If you can be able to catch something like this at least 3 times in a month, you'll be profitable. You are making times 10. You're making 10x of what you are risking. If you're risking $1, you're making $10. If you're risking $100, you're making $1,000. That's why you don't rush in the market.